Chapter 2, we start into the consolidation process. So basically, in order to consolidate the financial statements, we're gonna switch the terminology from the investor company and the investee company to the parent and the sub. So the parent is the company that owns 50% or more of that investee, who again we'll now call the subsidiary company or the sub. So if they control the economic risk and rewards of that company, they could actually consolidate with less than 50% ownership, but most of our problems are all going to be over the 50%. So the consolidation really is replacing it. So we're taking our parent company and we're adding in our subsidiary company into our consolidation of our financial statements. But we have to understand that what the parent has in that equity investment account represents the subsidiary company. So then we're going to want to eliminate the equity investment and replace it with the actual assets of the sub. So this is very basic to say, if we have $1,000 investment, it represents $1,500 of assets less $500 of liabilities. But in consolidation, we want to get rid of the $1,000 and replace it with the sub's actual assets less liabilities. So that is what we'll do when we get into those entries. So again, because an investor wants to see the real assets and liabilities, not just a one line item that kind of sums it all together. So then what would happen if we would just add those together? So here's the parents' books, here's the subs' books. If we simply added those together, we would be duplicating the subs. Our assets would be overstated by this $1,000, and then our equity would be overstated by the $1,000, and then our liabilities would, I think, would be okay because those are added together. But the equity would be overstated and our assets would be overstated. So we can't just simply add them straight across. So then here's an example again of that same, just that $1,000. So we're gonna eliminate the equity investment. So we're gonna credit that, and then we're gonna eliminate the stockholders' equity of the subsidiary company again because the parent owns them 100%. So the equity investment represents the equity of the sub. So those two will eliminate, and then the rest of the items will just be added straight across. So the assets are the parents plus the subs gives us the total. Liabilities are the parents plus the subs gives us the total. And then the stockholders' equity that remains is the parents, because the subsidiary company is solely owned by the parent. So the only outside third parties that have any involvement are in the parent company. So we'll do these journal entries that we do, these consolidation entries. They are not made inside the accounting records of the parent or the sub. The old boss where I used to work at, he would say these are on the top side. They're top side entries. So these are the entries that are actually produced by the parents' reports. We'll do these on top of those and then adjust them to create these consolidated statements. So here we have an easy one. If the purchase price equals the book value, so the parent exchanges 22,500 shares of its par value stock that has a current market value of $20 per share. So that's really the value that they're giving up. The 22,500 shares times the $20 per share. So then when you multiply those out, you see it's worth $450,000. Now when we do the journal entry, again, going back to our accounting rules, what goes to common stock is the par value, so the 22,500 shares at par, and then any value over that goes to paid in capital. So then when we go to combine those balance sheets, we are going to need to eliminate those. So this is our first consolidating entry. Now please note, this is our first time we see it. It will continue. We will continue to do these e-entries from chapter 2 all the way through chapter 6, and then we'll even pop back into them in chapter 8. So you want to understand them as they're introduced, because again, we're going to keep building on them. So if you don't understand this now, we're going to build on it every chapter from now until chapter 8. So E is representing our eliminating entry. Notice we color code it in green. If you are creating the consolidated financial statements in Excel, I would want you to do that. But we are eliminating our subsidiary company's common stock, paid-in capital, and retained earnings, and then the offset is eliminating our equity investment. Then the rest of the line items are simply added straight across, as you can kind of see as you go through that and eyeball it. Then when we come to our consolidated financial statements, we do not want to see any value in our equity investment. It should be 0. And then our common stock, paid-in capital, and retained earnings should always equal the parents, because like I said, the parent is the only company that has any outside stockholders. The parent owns all of the subsidiary. Now, chances are, though, you don't just get to buy these companies right at book value. They just show you that to make it simple. Normally, we're going to pay more than book value. So if our purchase price is $700,000 and our book value is $450,000, the difference is what we call the acquisition accounting premium. We abbreviate that the AAP, and then we go back to the problem to say, well, what did we pay the extra $250,000 for? So we have, it would tell us that we have property, plant, and equipment that was undervalued on the subs books, and they have an unrecorded patent of $125,000. And then normally it'll tell you that any residual amount is going to go to goodwill. So goodwill is more like that plug number. As a side note down here, there are times that purchase price could be less than the book value, but it's far more common to have goodwill. But if that ever happens, it's called a bargain purchase, and it would be treated as a gain. So then when we have those acquisition accounting premium assets, now we have an A entry. And again, like I said with the E entry, from this chapter all the way through chapter 8, we're going to have this A entry. So it's good to understand what it's doing now, so when we build onto it, it'll make sense. But what we're doing is we're revaluing their assets that are currently at historical cost. So we're increasing the value of property, plant, and equipment to bring it up to its fair value. So that's a debit. We are recording a patent that they probably developed and they could not value, but we are purchasing it so we can value it, and we're going to debit that for $125,000, and then the remainder goes to the intangible asset called goodwill. And then this is the other piece of the equity investment. So again, think back those couple slides. It said we paid a purchase price of $700,000. So we're breaking apart that purchase price to say this is how much related to the equity, this is how much relates to the acquisition accounting premium assets, and these are accounted for in these two different entries. And again, note this is green, this is A, and we code them with an E and an A. So that's what the good form is. So this is again a good form example of a consolidated balance sheet. So we've got our parents and our subs. We're increasing the value of the property, plant, and equipment. So then notice when you come over to the consolidated column, it's the parent plus the sub plus the A entry gives us that. Both of these entries have worked together to zero out our equity investment. That's one of our prime goals. We are recording in the new patent and the goodwill from the purchase. We are eliminating the common stock, paid-in capital, and retained earnings of the subsidiary company so that what is left on our consolidated balance sheet is just the parent. So again, study this and get comfortable with it, because it is the basis of all of the future entries that we will make. So then there can be many different intangible assets. So you just got to read the problem. If the problem gives you any of these intangible assets and they give you a value, we will record them. So don't question it to say, oh, I wonder if I should really record the customer list or the franchise agreement or the patent or the trade secret. If they give us a value, we're going to record it on our books, and it'll be part of that A entry. Now, acquisition-related costs. So if the company is acquiring, another company, there's a lot of costs involved. So you've got attorneys to file the paperwork, accountants and investment bankers, people who are going to go and review the books of the company that you're purchasing, value those assets to know what their fair value is. So all those costs are going to come in. If we did not issue stock to buy them, if we just paid cash, we're going to expense all those acquisition related costs as they're incurred. If we had to issue stock to acquire them, then we will charge it off to paid in capital, which in effect is reducing the value of the stock that we issued. So I think you may have a multiple choice question that asks about those two things. So acquisition costs are expensed as they're incurred. If the costs are related to issuing stock to acquire it, then we debit paid in capital. Okay, so that is chapter 2, but again, it sets the foundation for future chapters, so please try to understand it.